Good afternoon, everyone. I'm Emily Ackerman, the Director of Business Development here at Lane Gorman Trubit. I want to welcome you to our 8th webinar of 2022. Today's webinar is the second to last installment of our 9-part series, Aiming Towards Success. Today, we will be having a conversation on current insurance and risk strategies with my friend Brian Hunt from USI Insurance Services. We are always looking for unique topics for our webinars and look forward to continuing webinars into 2023. And to tell those of you joining for the first time today, Lane Gorman Trubit is a mid-sized accounting firm for all business sizes and will provide endless opportunities for gaining CPE credit. These events are created to help your business grow and thrive, and most are free. We all love free education. We cover a broad range of topics that are impactful to businesses in the construction, manufacturing and distribution, dealership services, real estate, and not-for-profit industries this year. But we always want to make sure we are providing you with the topics that you need more information about. So please make sure you fill out the evaluation after the event and leave a comment with your suggestions. If you have any questions about this or any of our services, or would like to set up a free consultation to determine how we can help your company or organization, please send us an email at askus@lgt-cpa.com. All of these links will be included in the chat. With that being said, let me introduce you to my friend Brian Hunt. Brian has spent more than 20 years helping his clients identify and understand how risk could impact their business. He joined USI in 2021 as a vice president for construction in the Dallas office, but he works a slew of other industries as well. In this role, he is the main point of contact to help USI prospects and clients think strategically about their construction-related exposure to risk, among many other things. Brian also, just to chime in about Brian received the Power Broker and Construction Award in 2020 and 2021 when he was named as a finalist for the same recognition in 2022. Brian is a friend of Lane Gorman Trubit's and a friend of mine. Brian, give us all that we need to know and all of our attendees need to know about everything going on in insurance and risk management. Take it away.
Well, thank you so much, Emily. I appreciate that. And thank you for the fact, I guess I'm the second to the last webinar for the year, because anybody watched Game of Thrones, there's always that second to last episode always is a wing banger at the end. So I'll try to make sure I live up to that. I'll live that up to that expectation. So thank you so much.
Anytime.
Yeah, so I'm obviously grateful for the opportunity to come out and talk to everybody as far as risk management, insurance, and what we're kind of seeing out there in the marketplace. And this conversation, obviously, it's not to just talk about just insurance, but also the overall concept of risk management and what is the risk management process, how you can take some of these sort of thought processes and apply them to your own operations, and not just your company, but also personally as well. And then I'll think about, we'll spend some time as far as what are these sort of the various lines of insurance that you might need or have, or you might need to think about placement and what it does cover, what does not cover. And then we'll try to maybe talk a little bit about what's going on in the marketplace as well.
Absolutely.
So, obviously with the next, so I kind of a little agenda here as far as what to talk about. I wanted to spend some time, we'll talk about first what actually is risk management. What does that mean? What does that term really apply to? And from there, what most people know about is insurance, which is really risk financing. And what are the ways to insure your lines of operations? And there's also alternative risk management financing, which we'll talk into as well. And obviously, questions at the end, but please feel free to send your questions during the course of the webinar, and Emily will help me sort of address those as we go.
Absolutely.
So here's just a great quote. What is risk management? And if you want to sort of break it down to the official lines and words, what it means is it's the concept of, risk management involves the efforts of individuals, organizations, to effectively and efficiently assess, control, and finance risk in order to minimize the adverse effects or losses or missed opportunities. And what that really means is, the whole thing is you got to think about what's that worst case scenario before it happens, and having to make an informed decision as whether or not you want to retain that risk, mitigate it, or transfer it. Because really, at the end of the day, you're trying to get ahead of the curve. You understand what your operations are vulnerable to, and make an informed decision of whether it makes sense to, what sort of efforts you want to do to sort of transfer it. Because a lot of times, unfortunately, people don't necessarily think about the worst case. everybody likes to be positive, but you don't necessarily stop and think about the worst case. And then unfortunately, sometimes it takes the disaster to occur. It makes you think about, oh, maybe I should have come up with a plan for this, or disaster recovery plan, or business continuity plan.
You're paying
And
for the
that's
just in cases. Exactly. That's it.
Exactly. And so, and the whole point is, like, as we talk about this, we'll talk about this, the concept that's evolved over the years is enterprise risk management, in the sense that think about what is your risk, your vulnerabilities to organization. And it's not just insurance. I think most people thought about in the past. It's, as we all kind of seen recently the past couple of years, what is your company's vulnerability to, oh, I don't know, a war breaking out in Ukraine, or a pandemic breaking out in China.
A tornado. You never know.
Yeah, a tornado. Or you're losing 5 days of power in February in Texas, which no one thought it would happen about, which I think Emily's had some stories about that. And, with high wind gusts that comes out of nowhere, it impacts your roof. So what are your plans for these types of things? That's the whole point, is to think about it, just to make an informed decision rather than be doing something on the fly. Go to the next sort of topic here, as far as now there's the whole process, risk management process. There's kind of a couple sort of 6 steps, and I'll sort of knock it down real quick. First, you want to identify your loss exposure. What exactly is your exposure to a certain type of event? Let's say, for the purpose of this conversation, your exposure is a supply chain disruption. You want to know you're manufacturing, you've got a lot of supply chain. What are your actual exposures? Identify those exposures. And then once you've identified, you need to analyze it. Look into it diligently. Look at all the shapes and angles of how this can potentially impact your operations. And from there, you want to think about, okay, let's examine what potential mitigation techniques we would have to reduce our exposure to these types of things, whether it be increasing your inventory, diversifying your supply chain, maybe buying your supplier to get integrated within your organization. So you have some options, and then you're going to select what you think is the most appropriate technique. And once you've made that informed decision, then you got to go and implement that technique. And then once you've done it, then the question, okay, you need to monitor it, because you got to make sure it was actually the appropriate technique. You got to monitor it, because this whole process really is a cycle. It's a life cycle, in the sense that once you've done something, you can't just be done, like implement it and be done. Yeah, because everybody knows the economy changes, factors change, whether it be weather, supply chain, political disruptions. You need to make sure that the technique you use is appropriate going into the future. So it's why it's never one that you once and done. It needs to be sort of an organic process within your organization.
Yeah, and there's no cookie cutter one. Every company, whether it's a
Right.
manufacturing company or construction, they all have different needs. There is no cookie cutter process. It's the same kind of roadmap for all, but every process and every need is different.
No, actually, we had a topic yesterday at USI. We had a guest come in and talk about cyber, and we'll get into a little later. Cyber is a major exposure, and everyone's got exposure to cyber, but some have higher levels of exposure. Obviously, if a cloud-based service provider has a greater maybe exposure to IT, and needs to be able to run faster than, say, cement production and distribution. Still have exposure, but your level of preparedness and your level of response is different. And again, based upon what is the impact to your operations, your clients, your bottom line, and what is sort of the dependence you have on those sort of systems. And that's the exact point, Emily. It's like Emily talking to you about business continuity planning or disaster recovery plan or enterprise risk management. It's like you can't take something off the shelf and apply it and think you're done. It has to be tailored to your organization. Good point. Go to the next. So risk control techniques. So we talked about risk control. What are the things you can do to, what are some of the options? And I'll try to give some examples on this. So the first one is avoidance. And let's just take them at a personal level myself. I picked up skiing relatively late in life. So I can do greens, I can do some blues. I have no desire to go down to black. So I'm going to avoid blacks probably for the rest of my life until I get some real serious confidence. So for me, not wanting to blow out my ACL, I avoid blacks on a ski slope. And the same thing might be if you're, say, like in construction, some people are really good at doing horizontal projects. Some people are really good at doing multifamily, and they're two different animals. You might just want to say, as a company, I'm going to avoid doing multifamily and just strictly do horizontal projects. So you've decided that's something we're not going to do.
Mm-hmm.
Loss prevention. Loss prevention is the whole concept of sort of think about it from say, supply chain is very valuable these days. Copper is going to be very valuable.
Yeah.
Loss prevention is exactly on a job site. You've got to 24/7 monitored. You've got a security gate. You've got armed guards. You've got video surveillance. So you're trying to prevent potential loss. Actually, keep it very secured environment. So loss prevention, or like say, even to say you're like a retail store, you've got security, video surveillance. You're trying to prevent the potential loss. You have the tags on your garments. So if somebody walks up the door, it alerts the monitors. Again, loss prevention. Loss reduction, that's the whole concept. It's like, say, you have a manufacturing plant and you're susceptible, it's your only plant. What are you going to do to reduce potential loss? Well, one thing is obviously installing like sprinkler protection systems and making sure that the sprinklers are monitored, make sure they're always diligent, always activated, and they're on. People, unfortunately, would find out some of the worst losses you might see in insurance is that sprinkler protection service system comes in, they work on it at night, you got to turn the water off. Someone forgets to turn the water back on.
No.
And that's when the fire. No, that will be some of the worst losses you're able to see is because they were working on the fire protection system and they didn't turn the water back on, and then that's when the event goes on. So that's kind of like, that's what the issue might occur. But like say, loss reduction too is like say in the manufacturing, you might build a firewall which halfway between your building. That if the fire starts on one side and goes through the course of the building, that firewall should prevent any damage occurring to the other side of the building. Or even to the point like say, if your building facilities are in a seismic area that is built to have seismic reinforcement so that if it hits a certain earthquake level, it will withstand that disruption or shaking. Also think about if everybody lives in Texas, high wind, you want to have more resilient roofing versus others, because I think we're all starting to see, and we'll get into this later, like what happened in Fort Myers. Some of the buildings that were newer withstand the impact. The older buildings got destroyed. And so the question of building to be more resilient to adjust to climate change is something that the carriers are going to want to see. Separation, that's kind of think about it from this point. Like say you've got like the idea, like say you've got a key supply chain material, rather than have it all sitting under one building, you might have it one in your warehouse and the other half of that inventory might be sitting in a bonded warehouse or at another facility. Therefore, if one goes down, you're not losing your entire supply component. Duplication, same sort of thing. You might have the concept where, like say, manufacturing, you might have two separate plants that make the exact same components. And so if they're on other sides of the country or even other sides of the world, if one goes down, you can ramp up production at the second site, go to double shift, maybe go to the weekend to try to increase production to make up the loss of that first building. And then diversification, that's kind of like, I think we all know as far as like even in your own 401k, you want to have a diverse investment portfolio to reduce your risk and systematic risk. Diversification is maybe you do, we go in like the construction component, you decided to like diversify into other states. Been in Texas, but now you want to try to start operating in Alabama. So you're diversifying your exposure to the economic conditions in different parts of the country or different parts of the world. Next slide. So risk financing, really it comes down to is there's really two ways. You can either you can retain that risk or you transfer. And what does retain mean? Well, really to say, you think about it, let's say you take a look at your operations. Let's say you have, for the purposes of the argument, like a cyber. And you think, well, we might have a $1 million exposure to cyber. And let's say, we're not going to get insurance. We're going to retain that. So if you're doing that, your cost savings, you're not paying for the premium. You feel like you have better control of the claims process because you're not having to rely on a third party to do your claims. You're going to be basically paying out the claims, doing the investigation. Better timing in cash flows because, again, the money is going out in order to transfer that risk. And if you really are retaining that risk, then you've got a major incentive to ensure you. Hopefully, you're taking that incentive to really implement strong procedures and security on your IT system, so that you really are just to retain that risk. You're on the line. You got to make sure your people and your systems are robust and resilient.
For sure.
But then you might want to say, you know what? Don't feel comfortable like that. I'd rather sleep at night a little better, so I'm going to transfer that. So that typically is by doing insurance. You're going to a contract with an insurance carrier, and you're going to transfer that risk off your balance sheet to their balance sheet. So again, you expose yourself to large losses. Hey, if I get a $3 million hit and I've got a $3 million limit on my policy, I'm sleeping good at night. The insurance carrier is going to take care of that. You reduce cash flow variability in the sense that, I'm going to pay $50,000 a year or $25,000 a year for that insurance policy. That's my outside deductible retention levels. I know that's That's what I got to pay, the check I got to write. I don't have to worry about the claims coming in at 10,000, 20,000, 100,000 here. Now, also, what the great thing about using insurance carrier, if you have get the right carrier, lien carrier, for that premium you're paying, they might pay ancillary services. Would be risk control specialists that come out to your operations. You can do, looking at your production floor, your job site, make sure that everything's looking at health and safety standards. Also, from what we're seeing these days, a lot of the carriers that are offering cyber protection are being proactive, where they come out, they will come, first they underwrite you, they will scan your system and give you a report card, and they will sort of consistently throughout the course of a year go back and scan your system for any potential vulnerabilities. So they're trying to be proactive rather than reactive to any claims. And then also sort of, there's a component as far as if you transfer that risk, you have some confidence if you take a major hit, you'll be back up and running the next day. So you're avoiding a potential adverse employer public relations knowing, rather than say, hey, there's a concern that might no longer be a going concern because they took a massive hit and they don't have the ways to pay for it. Okay. So now I think a lot of people will talk about insurance. There's a lot of different lines of insurance. So I kind of want to spend a little time just kind of going through some of the sort of basic functions of what insurance, some you might have, some you might never have heard of, and maybe some to think about in the future. So commercial general liability, I think pretty much everybody has a general sense of what this is third-party exposure to things that might happen to your organization. Think about like construction, if you got somebody who's walking around your job site and there's a fence and the fence falls down on them, that's third-party liability. There's a lot of different things that sort of covers your basic, operations. There are considerations, limitations that occur to this. There's things that aren't necessarily covered by general liability, by things like professional liability, watercraft, drones. FYI, to somebody here, in case you make sure, if by chance your operations uses drones or you have a third party that does drones on your behalf, drones have been considered aircraft by the insurance carriers and also more specifically by court rulings. Yes, because a lot of times you have aviation exclusions on most policies. So there's court precedent saying that they consider drones to be aviation or aircraft. So if a claim occurs as a result of that and you have an aviation exclusion in your policy, you're not going to get covered for anything that happened as a result of the drone. So there's separate coverage out there. You've got UAS, unmanned aircraft systems, UAS. That's a separate policy, so something to think about. And then wrap-ups, we'll talk about that later. Those get excluded from the GL. And then some of you people might have heard like asbestos, silica, mold, and fungus. Those are very nasty events or claims that can come, so you need to have a different coverage for that, and the GL will have exclusions for that.
You would think with all of our flooding and rainstorms that we have, that mold would be covered, or is it because we all will get so affected by it as just a population? Is that why it's excluded?
No.
I'm just curious, asking the question.
No, that's a good point. I would point back almost say 15 years, 20 years, especially in Texas. There was a big run of mold claims that people were advocating and playing against, especially residential, like your State Farm, your Allstates kind of thing. People having mold claims or making mold claims. The carriers are starting to make a lot of payments, whether they're justified or not. There might be some people taking advantage of it, But the point is back, carriers were taking the big hits. They said, you know what, we're going to exclude mold from the coverage. And we'll get into that, but that's a very good point, Emily, to think about. From anything that you have, people understand your insurance policy is a written contract. It's a contract between you and the carrier. And it's written by lawyers, and it's all about the wording. And not every policy is the same. But the key thing to understand is that if an exclusion is added to your policy, what the carrier is specifically saying, we will not cover this. Asbestos, mold. If it's an exclusion on your policy, we will not cover claims related to this. If it's an endorsement to your policy, basically what the carrier is saying, we will specifically state we will cover this type of thing. So there's constant people like in general liability, if it's not endorsed, is it covered? That's where you get the court precedent. But really specifically, you want clear as day, I want this covered. That's an endorsement. And there's a little basic math, guys, will wrap your brain around this. But remember, an exclusion takes away coverage, but an exclusion to an exclusion adds coverage to your policy. So a negative times a negative is a policy. Is a positive. So like as a quick example, exclusion does not allow you to will exclude any coverage for anything in the state of Florida. So let's say it has exclusion for the city of Tampa. So your coverage will have nothing for Florida, but it will include anything in the city of Florida. That's kind of a simplistic way to do it, but that's how that works. The next line here we're talking about is workers' compensation. I think most people know about slip and falls, injuries on the job, lost employment. That's what happens. So say if your employees get hurt, they have medical coverage outside, not your health and benefits. It's for them to be covered by your workers' compensation. Things to be covered. The one thing that people understand is in Texas, there are ways a company doesn't have to pay for workers' compensation, but they have to prove to the state they can pay for workers' compensation. So that's you got to file a bond or file financial statements with the insurance regulatory agency to justify that I'm not offering workers' comp. But the simplest way that most people do is they go ahead and pay for workers' compensation. Next. Business auto. Think about that sort of standard. Your people out there driving, whether they're non-owned auto, you're out there driving around on behalf of LGT, doing meetings, and something happens, you get your car wreck. That's where your company is covered for business auto. Or it might be actual trucks that they own. So a lot of times in construction or delivery, you've got actual, the trucks with the logo on the side, people are driving around. That's the cover for business auto. Same thing we all think about, your own personal auto, collisions, hopefully no one, major fatalities. And all things questions about, hit pedestrian walking the streets or you're rear-ended a vehicle. That's sort of like you would your personal auto. One thing about those is this is kind of a very tough market right now, especially if you are a company out there has a heavy auto, like say semis, heavy trucks, dual wheelies kind of thing, construction. Because what we're seeing really bad, we'll talk a little bit later, is what we call these nuclear verdicts, where these claims are being submitted, and you're seeing like $5 million, $7 million, $10 million judgments happening more often. And typically your auto's got to be a $1 or $2 million policy. And then if it goes beyond that, then you're going to go into what we're talking about here in a second, the umbrella and the excess markets. This is a really tough market for people out there. The carriers are really taking a lot of hits, and they're very much looking to tighten up their exposure to this. And so you might be seeing a lot of the carriers want to see what you're doing from a training of your drivers, putting telemetrics as far as devices, goggles that track the speed of your car, of the auto. Even we're starting to see where companies are doing with their carriers and putting video inside the trucks. It's not only recording the driver, but also what's in front of them as well, because the docking thing might happen as a result of a claim. Go on to the next one.
Hey, Brian,
So
before going off, before really quickly, there is a question that just since we were covering the business auto, one question that came in was, does business auto cover a rental car that I rent while on a business trip? What are the downsides to that type of auto coverage?
Yeah, no, that's a very good point. That goes back to the whole concept. Like we can spend a whole lot of time here, but your basic auto policy has different grades as far as what's covered and not covered. And so it can cover your rental. And because think about it this way, let's say you're going out there driving around and you go get a rental car, it's not covered on your auto policy. Well, what you might need to do is pay for the insurance of the rental car. That's extremely expensive. I mean, that's a profit maker for the insurance carrier. They're going to mark it up. I mean, for the auto rental company, they're going to mark that up. But it's always been beneficial if you're out there driving around on behalf of your company or the company you're doing work and getting rental cars. It makes a lot of sense for your business auto to have that coverage. That's a specific endorsement you can make sure you have and talk to your insurance broker or carrier to ensure it's there. Because rather than like having all your individuals go out and get rental, everything goes to Davis or Avis, Hertz, whatever. Every time they do that, that can add up quickly. And again, that's not a very efficient use of your capital. But having that added specifically to your business auto really sort of reduces your overall exposure and reduces any gaps in coverage you might have. So, short answer, it can be added to your business auto. Most times it is, and I would highly encourage you to have that conversation. So,
awesome.
Umbrella. Yeah, so we talked about that earlier. So umbrella is sort of, think about this. We just talked about three lines: general liability, auto, and workers' comp. Those are sort of the three big drivers, three sort of standard policies that most companies have had forever and will end of time. And so, like a lot of times, the workers' comp might be kind of up to 1 million, GL might be 2, same with auto, maybe 1. But you might be out there working on projects, and your clients, your owners, they want to see you have coverage, say, for 5 or total for 7, wherever the case may be. So you need some additional coverage, and that's what it is an umbrella. It does sort of sit like an umbrella on top of those 3 primary lines, and it provides additional coverage. Some carriers, let's say you might get 5 or up to 10 million in umbrella, and so that increases your overall coverage from those exposures from your business, your auto, and your workers' comp. Now, we talked about earlier as far as the nuclear verdicts. If something goes bad, you have a big claim that hits your auto and it goes past the limits, and that's where the umbrella is going to kick in. And we'll tip, it's always beneficial if you can to try to have your umbrella with the same carrier. Actually, I always advocate if I can, but I'm trying to get work comp, auto, GL with the same carrier and love to have the umbrella on top of that because you're dealing with the same claim team. The wording should be relatively similar. You have no potential gaps in coverage because if you're dealing with different carriers on your auto and you have an umbrella, the concern is that maybe the auto has limitations. You have coverage for one, but the basic results of what happened, the umbrella might have an exclusion. It doesn't pick up the coverage, so you might have issues there. And then, so what also you're seeing is that these claims are starting to go into the umbrella. And then the next component we're going to talk about is there's also what's called excess. So if you've got a project, you need to go up to $40 million a limit, and you can only get, say, 15 with your standard GL and your umbrella, you got to get the rest, and that's where the excess comes into play. And what we've seen a lot is that these, like, especially on the auto, you're starting to hit into the excess markets. Fewer carriers are willing to be in the excess markets because they're losing money on these auto claims. And so what might be like a 1 or 2 carriers sitting on top of your umbrella, you might have to go to 4 or 5. So that means you're dealing with if you get a claim, every time it goes from one level to the next, you're dealing with a different insurance adjuster. So that can be very complicated. So on to the next. All right, so we talked about this a little bit earlier. So professional and pollution. This is a combo policy, especially if it's applicable in construction. So we talked earlier about general liability has exclusions and very limited coverage for pollution, but based upon your nature of your business or what you do, you might need a little more robust coverage. That's where a separate professional or pollution policy is needed. This will pick up the asbestos, the mold, work that you might be doing, hazardous spill that occurs where your truck gets into an accident, carrying a lot of diesel or cleaning solvents and goes into the river. So that's a whole EPA hazmat cleanup that would not be picked up by the GL, but this will sort of help with that coverage. And so actually, typically you might see professional and pollution separately, but this is what sort of a newer trend in certain carriers are offering to certain industries where your professional and your pollution are combined together. Next slide. And again, this sort of talks about things like lead contaminated soil, silica, PCBs, spilled fuels, or lubricants. It really is that sort of, again, we talk about you need to look at your operations as a whole, understand what you do, where you do it, what sort of materials you're handling with, and understanding if you need that special extra level of protection for your operations that can't be just picked up by your GL. This is where looking and understanding your business operations, what you do, making sure you don't have any gaps in coverage and providing this extra line of coverage for your operations. Next. Builder's risk. So this is something that people might be familiar with, especially it's either you know it from construction, or if you're out there, you as a manufacturing plant or pharmaceutical plant, you've got a brand new plant you're being built for you. What builder's risk provides is coverage so that during the course of construction, from the day you start to like that last day until you hand it over, you, the owner, receive it in the finished condition. If anything happens in the course of construction, tornado, fire, earthquake, high wind, blows down wind, this is to help reimburse you for the lost costs, sunken costs that you might have occurred. So like you got to say you got a $50 million project, you're halfway through it, and your total costs have been put into this project at $25 million. If something happens that day, the policy reimburses you for like what the like kind of status at the time of the incident. So in that situation, you'd be getting reimbursed $25 million to rebuild it.
So silly question, just with a couple weeks ago with the bad rainstorms we had in August, I saw some videos of some buildings that were in the process of being built that literally with a big gust of wind, all of the wood paneling got blown down. Is that something as an example?
As a perfect example, Emily, and that's actually I did a post on that as well. So that was that video on YouTube where it was a great video. It was like it was in its stick frame multifamily housing, which by the way, carriers hate stick frame multifamily carriers. A lot of the big boys, the AIGs, the Chubbs, they won't touch it. So a lot of times multifamily builders need to go to the excess lines, go to the London syndicates to get coverage. So that's a very good point. So yeah, that's exactly it. So as you saw in that video, it was all like 2 or 3 stories. It was stick frame. There's a lot of time and effort and labor at that point, but at that point, it wasn't finished. So it all got blown down and probably, and they'll look at the whole thing, but I'm sure it was like completely redone. So whatever that cost was for the project, again, it was say $100 million project. Halfway through, it was $50 million. Then that would be $50 million worth of a claim you're going to get to rebuild. Now, the bolt-on or something to think about, especially if you're an owner, you're building something for the purpose of making revenue. You want to either you're going to rent it out as apartments, or you're going to have a manufacturing plant that's going to generate widgets you're going to sell. That's called time element or business interruption coverage, or it might be called loss rents if you're talking about an apartment or office building you're going to rent out. So let's say it takes you 12 months to build something, and you were planning from the day you sold that. Once you're going to have it finalized, you have tenants lined up, or you're going to produce. You could say, I plan on having a gross profits, not sales, but gross profits, or actually we call it contribution margin, because what the claim will be, you don't get a check for your sales or lost sales. It's the sales loss minus your variable costs. So for the purpose of this same contribution margin for all my accounting friends out there. So if you had built that, you anticipated I was going to build this, operate it, and I was going to know I was going to get $10 million in contribution margin a month. And then, hey, I lost my building. Well, yeah, you lost the building, you got to rebuild it, but you've also lost the entire business cycle you're hoping to get revenue for. You might have had some financing in order to do this. You had some tenants lined up. You can get business interruption coverage that will reimburse you for those lost contribution margin during the course of construction as you rebuild, so that you have not only no hole in your balance sheet from the loss of that building, but also you think about your pro forma you put together to justify this building or increase in manufacturing. It's going to help you smooth out your income statement during the course of rebuilding. So that's something to think about. It's not automatically added to builder's risk. It's something you need to think about. Contractor's equipment, and Emily and I can have a little conversation joke because she and I look out this window. There's a job site going on, and someone had a very heavy piece of equipment slip on its side. And so this is where the coverage for contractor equipment is going to come.
Literally outside of our window with all the quadrangle construction.
Yeah. Yep. So think about this. This is like what we call, we say the heavy yellow iron, because you think about, it's got a photo here of like a Caterpillar. That's usually big and yellow and heavy. This is stuff your employees driving to and from job sites or rental cars. This is like bulldozers, cranes, forklifts, big old things that you have to move and transport. Obviously, there's a lot of value. It's required for these job sites or whatever you're doing. So you want to have these insured. That's a separate policy for contractors' equipment. It's not part of your auto policies. That's everything is in. There's a strict value on the limit. You want to make sure you have proper limits in place, because some of these things could be $1 million, $2 million to replace, especially these days on back orders and supply chain issues. And then also, the question to think about, if you're renting this information, like let's say a lot of times general contractors or in subs, if they own this, you might go to a United Rental or someplace else to rent it to bring to the job site. Well, United Rental might be charging you insurance for that, but I guarantee you it's going to be a higher rate and more costly than if you had your own insurance policy that you insured it yourself. So something to think about specifically on that. Next. Property coverage, personal. Think about that specifically. It's just like, say, stuff you own. Like we're here in the Lane Gorman offices. I'm looking at a lot of very nice computers and desktops and desks and chairs. That's what you're insuring, your personal property, that thing that you own. And so, like, if like we say back in my old days at FM Global, if you turn your building or home into a smoking hole in the ground, what's it going to cost to replace all that with like-kind status? Now, key thing here is too is like, and I think unfortunately people are going to start hearing this, learning the hard way. So everybody here, don't just think about your personal life, but not your business, but your personal. Because you've got, like, say, your homeowners. Your homeowners got standard like fire, satellite crashing on your house kind of thing. But like, I'll give you an example. About 20 years ago, I'm in my home in Dallas, Northwest Dallas, and all of a sudden my home starts shaking. If you guys remember, about 25 years ago with some of that fracking, turns out there was a seismic center over in Irving, Texas, where the old Cowboy Stadium used to be. That was in radius. I felt that in your house shake and go, oh gosh. called the carrier agent. Well, I didn't have earthquake protection at the time. So and most people in Texas, you don't get earthquake automatically. You got to ask for it. Most people in Texas wouldn't think about it. But then when you have your house shaken, you know what? I'm going to probably look into that. Pretty cheap because you wouldn't expect a high seismic exposure in Dallas. But since I felt it, you never know what the worst case is going to happen. I specifically got earthquake coverage on my home. And to that point, this is why a lot of people are going to find out, especially with global warming, flood. You need to understand whether or not your home is in a flood zone. And people have talked about what is 100-year or 500-year. That's based on past precedent. If your home's even touching remotely in a 100, 500 flood zone, I would have a very strong conversation with your agent to understand what's my coverage, is there any limits, and you can go online and find flood maps. Like FM Global has it. You have that. A lot of firms have that available. You can go to FM Global. You can go to flood maps, type in your address, and show you where your properties are. Based on current modeling, are you in a flood zone?
Because even a question I have that comes from that is like, granted, right now things are fine and dandy, but look what happened just a couple of years ago with Houston, with Harvey.
Right.
At what point do you think Dallas is going to be beachfront property? Because even just with a little bit of rain for like 20 minutes, just the flooding that you see around Dallas, whether it's Trinity Groves and surrounding areas, it's just gotten so much worse over the years, more than I recall.
And it's a great time, Emily, to bring forward that this is the trend overall in insurance, and I would point everybody to think about. First of all, let's stop and think about what insurance is. Insurance company is a for-profit organization. They're not doing this looking to lose money. So they're doing underwriting, looking at the data, the analysis. They want to understand, let's think about, don't just think about like commercial, think about home. It's like home property. Let's say you're a big carrier and you've got diversification of your assets. You insure a lot of different people around the country. That's big numbers, and that's diversification that helps them. But if you got a heavy concentration of exposure, let's say in Florida, and you're starting to see, people have been seeing this from Andrew and Weber, but see more frequency and severity of hurricanes. And so the question is, we talked about this earlier, say Fort Myers. All the videos you've seen in Fort Myers, the newer homes look like they withstood, because as a result of changing code, they had to be more resilient. More expensive, they had better materials, but they were more resilient. Therefore, they withstood it. A lot of the older homes got destroyed, decimated. And so at some point, it makes sense. The carrier's going to say, and it's already started happening, you know what? We're not going to insure this anymore. Unless you build it to be highly resilient, or especially if you think about it from it's like commercial developers. A lot of times commercial developers, they build it and they just want to sell it and move on. But the carriers whoever's going to buy that thing in the future needs to understand the carrier, you might have a hard time getting insurance for that property, because if it's too close to the water line, as sea levels rise, and as hurricanes get more damaging, flood goes in, the waters will go in further into the inland. And so your facility might be more exposed to flooding based upon what it is now. And so carriers are going to want to see you being more resilient, using better materials, higher resistant materials in your roof, better embracing on your windows. That's where it's going to start going to, that you're going to have a hard time finding carriers that are willing to sign off on projects unless you prove to them you're being more resilient. And taking account flood maps is part of that process. And so the underlying concept in insurance is called moral hazard. And developers, if they can get the insurance for flood insurance, they're going to go ahead and build it. And go, hey, if I got flood insurance, the carriers are going to reimburse me. So there's almost like, that's what we call, I'm going to build it even though it's in an exposed area. But we're starting to see is that the carriers are pulling back on coverage. So owners either have to figure out, pay to be more resilient, or maybe not put it in the most pristine area you want to, but further inland, or the carriers, the owners are going to have to take on and retain more of that risk with higher deductibles, or just flat out self-insure. Good point, though. So quickly, now some of you out there have been maybe what a bond is, or you get bonded or surety. So a bond and insurance policy are two separate things. An insurance is a two-way contract. It's between you and the carrier. You have a contract. Remember, it's a written document. I paid premium. Something goes wrong. If it's covered, you reimburse me. Two-way contract. Surety is actually a three-way contract. And if we go to the next slide, it'll help sort of describe this a little bit better. A surety is actually where you say you're the principal, say you're the contractor, and I've got to subcontractor I'm going to put on this job. I'm requiring the sub to be bonded, so I got faith and credit that he's going to perform this job, and no matter what, it's going to be performed. So a surety underwriter for the third-party insurance company, but it's not insurance, it's a bond, will say, I will testify that this individual, this firm, will deliver on time. And it's like, process is very much similar to like applying for a bank loan. The underwriters they want to see your income statement, your past history, your character, your capacity. It's very diligent, a lot of questions, and they really want to know you about you and your operations. And so if something was ever to go wrong, the principal, like in this situation, the contractor has confidence that the surety underwriter or the surety carrier will respond and make sure that the project is completed. Now, the funny thing about this, very few times, it's not like you get an automatic check. Surety underwriters, they're going to either, if they have to, they're going to bring in another sub. They'll take over cash control for the subcontractor. The surety underwriters go out of the way to try to mitigate or solve the problem rather than just cut a check. And so it's kind of interesting in the sense that it's required, but very few times you ever see a claim just because the way the nature is of sort of the surety underwriting. But it's not a contract between two people, you and the carrier. It's a three-way contract. So, and to go to the next slide, you can kind of see there's two different ways. You have a contract surety, which most people understand, GC and a sub, but then commercial happens a lot of times. It's like you're working for the government. Almost any project for the government requires bonding. And there's different level types of bonding, performance bonding. I want to get details on that, but it's just it's a different variation of risk transfer. So wrap-ups, just to kind of wrap it up. Most people understand the process. You have, like, say, a GC's got like you have an owner, gets a general contractor, and the general contractor has the sub and their second tier and third tier subs, and everybody's got contracts, and everybody's trying to indemnify each other and push the risk downward. And with parts of countries, there are states called anti-indemnity statutes, like especially Texas, where Texas Supreme Court has said that's an abuse of power because you, the owner, are leveraging your relationship with the GC, and GC doing the same thing with the sub all the way down. You're basically saying either you indemnify me or you're not getting this job. And that's basically the Texas Supreme Court. So that's a violation of Constitution and abuse of power. So in order to get around that situation, wrap-ups have been developed. And what a wrap-up is sort of thinks about it. Rather than having all these individuals with their own insurance policies, you got one policy that's a lot of times project specific, that everybody on that project gets enrolled in is part of that contract. And it's cleaner, it's tighter, get less exposure 10 years down the road when a claim goes down. You go back and look at that sub, and it turns out they were bankrupt or they didn't pay their insurance premium, and they're trying to move up the food chain. In this sort of environment, it's just one policy that reacts to it. And it's something you see very much on the larger contracts. I kind of tell people if it's, say, $100 million or more than likely you're going to see a wrap-up project, because a lot of times the lenders, the big banks involved, they want to protect their interests as well. So more likely to see a wrap-ups involve these types of situations. Go to the next one. So there's a couple of different options for wrap-ups. And there's OSIP, where the owner controls it. There's a CSIP, where the contractor controls it. Rolling SIPs, where it's really not just doing one at a time, but you might look at your bandwidth, your backlog for the next 3 to 5 years, and you sort of pre-negotiate your rates with the carrier, and the carrier say, okay, anything that's less than $200 million, you can automatically enroll as a wrap. What you might also see is called more popular these days, the GL only. That's popular because what you only have one policy is general liability, because a full bore wrap-up usually has general liability and workers' comp. That provides more coverage, but also in order for someone to be on the job, it means every single worker at the job site has to be enrolled on the wrap. That's kind of a tedious process. It's kind of laborious. If you just do general liability, all you're doing is enrolling all the individual firms one by one. It's a little cleaner and a little easier to administer. Next. So P3s, that's again, it's got a big trend. I know right down in Austin, it's a P3 that's being used for the development of the Travis County Courthouse. ProSIPs, as it sounds, general liability, it's both the owner and the contractor are sort of sharing it together. And then dirty OSIP, or environmental, where it sounds like it's some sort of large-term environmental cleanup project, might span a couple of years, and so you have the same sort of process, but your environmental exposure. On the next. Cyber. Everybody knows about this. So cyber is a big thing that we should be worried about and know about it. And it really is to cover, now again, there are limited coverages on general liability, but from your big exposures from malware, ransomware, your system being locked up, extortion, those things come under cyber. And so, there's things that specifically would be coverage for first party breach events. If you get breached, you get the response team to come help you out. First party coverage, network security failure, or cyber extortion. Big thing here, guys. I cannot stress this enough. You got to understand the thing that a lot of times hits most people. It's called social engineering. That is when someone impersonates the CFO, sends an email to the controller. It looks like it came from the CFO. Hey, I need you to wire $10,000 to the Caymans or whatever. That's not a breach of your system. It's just impersonation, social engineering. And so what that is, you need to understand, does your cyber policy actually have coverage for that? And if so, is there a limit to it? A lot of times those sort of things are smaller limits. If it's not there, it's got to be on your crime policy. Go back to the next slide. You can go to the next slide. But the big thing is make sure you know the two are working together. Cyber also has coverage of third party, that's sort of technology errors, omissions, media liability coverage, like something, your website gets compromised, someone puts libelous material on your competitors or former employee, you got exposure there. And also like payment credit card industry security standards. So it's, again, third party coverage as well. Next. Management. Okay. Big thing here, guys. Just because you're a privately owned firm does not mean you don't have exposure to D&O or employment practice liability. I think it's a common misconception that, oh, I'm small, I'm owned, I don't have a concern for D&O. No, you do. EPL applies to anybody. You've got an employee that says something wrong, inappropriate. That's work sexual harassment. That's definitely a coverage there. Fiduciary is thinking about it if someone abuses the funds that were supposed to go to the 401k or for your health and benefit premiums. You're taking money out of your employees' accounts and you're supposed to send them to the third parties and somehow it doesn't get done. There's your liability. And then also special crimes be done as far as if you have people get traveling owners, kidnap, ransom, extortion, that's going to be picked up as well. The thing is management is it's typically designed for small and mid-market accounts. And you have the ability to sort of combine it into one package. But the thing is you got to understand you need to at least have two coverages to work that. Right now I'm working with a general contractor. They privately held. They don't have D&O or EPL, so we're putting that together. And then I'm going to make sure, so that's part, they can do that together. And then down the road, if they want to add fiduciary, they can do that as well. And again, usually only able to privately held firms, nonprofit organizations, and small publicly traded companies. Those with sales under 25 million. Captive. Okay, this is sort of the hot term maybe wants to know about. People might have heard this before. Policy rates have been going steadily up pretty much across the board for a number of years. And you're probably still going to see that in commercial property. We talk about commercial auto and GL and excess and the claims that result in that. You might be doing great. You have no losses. You've got health, safety. You know what, man? I'm still getting these increasing rates. Why? And I'm doing a great job. Why am I susceptible to the rest of the market getting lumped in with anybody else? What you can do is go into a captive. There's a couple different forms. There's group captives or single source. But basically, you're starting your own insurance company. And you're either doing it by yourself or with a bunch of people. And you're using that to, hey, you know what? I feel good about what I can do. I can retain more risk. So rather than having going, like, say, I'm making numbers up, I pay $1 million a year for my workers' comp. I'm going to pay to the captive, let's say I'm going to pay $400,000 a year to the captive. So I got a delta of $600,000. I'm going to roll that into the captive. I'm going to take a bigger claim, like you probably have a higher deductible. So the first $250,000 of claims you're paying for yourself. You got to understand that your savings premium, but you got to account for those additional costs and claims you're going to do yourself. But let's say after the 1 year, you've gone through the cost and you find you did your claims, your health and safety is great. You end up paying $800,000 versus $1 million. Well, then after that first year, you've got $200,000 sitting in that captive to help you retain future losses, and you can invest that. And it rolls for the next 5 years. Let's say you do a great job after 5 years. Every year for 5 years, you end up saving $200,000. After 5 years, you grow, you got $1 million, maybe plus as a result of investment returns. Now you've got your own big reserve pile that you can take on bigger risks. And from a construction perspective, the larger GCs, like I used to work at Austin Industries, they have their own captive. This is a very much a captive, and doing wrap-ups can often be a very large profit center for general contractors because they're able to bet more on themselves and as a result have lower cost insurance, and they take it seriously. It contributes a lot to the bottom margin. And that's maybe risk management 201. We'll get into that next time. So maybe last couple of questions here. Now, path, it's a sort of quick little description as far as not everybody should do it captive. It's like you start at the bottom, you work your way up. Next slide. Couple different structures: single parent, group, protective sale, captive. Next slide. Things to know about it. The way I tell people in this is like going in the mob. It's once you're in, it's really hard to get out. And so if you're going to go to a captive, you got to take your health and safety seriously. You got to take training seriously. You got to make sure it's ingrained in your culture that you're going to be safe and taking care of your employees. It's not just looking to save money on your insurance. You're retaining more risk. Therefore, you got to be more resilient. Next slide. Parametric, the newer thing. It's about using large data to help transfer risk, which you could not do in the past, specifically weather events. Construction, obviously in agriculture, so whether it be wind, snow, it can impact your operations. In the past, any exposure, cost overruns, penalties that you lost as a result of weather incidents. In the past, you couldn't transfer. Now you can. Next slide. Basic thing, best practices, talk with your risk management group. It's the concept of buying insurance and walk away next year is over. Enterprise risk management, you have to understand your operations. Does your insurance align up? Not everything's insurable and not everything can be transferred. So health and safety, but it's all about the whole organization being more resilient, knowing your risks, knowing your exposures. Can you transfer? Can you not? And if you're not able to transfer, what sort of plans do you do to mitigate or reduce that overall exposure? If you have a supply chain disruption, if your IT system goes down, if the state of Texas lose power for 5 days, what are you going to do? So next slide. Quick little heads up as far as USI construction practice. We got a lot of people, a lot of offices, a lot of experts who do this. Happy to have a conversation. Anybody needs any help. And we do other things as well at USI too. I think the next one is questions. And again, hope is not a plan. You cannot just hope for the best. And you need to understand and think about what's the worst case scenario and come up with a plan. So plan for the worst and hope for the best.
Oh, yeah. And insurance is, you're literally buying peace of mind. And you
Correct.
hope that these things never happen. But even just going on weather, one day in Dallas, it's 85 degrees and sunny. The next day is 30 degrees with a blizzard. And then the next day is a tornado. You just really never know. And one question just before we wrap up, because we are coming to a close. Right now really is kind of enrollment season, or when, especially in our world, when the accounting world, people really don't feel like switching CPA firms unless there really is someone retiring, really dropping the ball, responsiveness. What are some reasons that people are usually making a insurance move around now?
Sure. Yeah. I mean, it's like the old adage, when someone starts with a firm, they start off with a subcontractor base for a $2 million project. And as their company grows and doing $50 million projects, odds they're not using the same subs. So they're getting larger subs that have larger capacity that can help their growth plans. And that's what happens a lot of times with, why someone would come to USI, in the sense that their smaller regional broker have a hard time getting certs out on time. They can't get the proper endorsements on the coverage. They have claims. They're not getting support. All these things, I think we help, are built around to help provide our clients, take them to the next level as far as having in-house claims advocates, using technology to ensure we have the ability to get certs out on a regular basis. And then obviously, the bigger you are, the more leverage you have with the insurance carriers versus a smaller firm. And we do $2 billion annual revenue. We've got 9,000 employees around the country, 220 offices. So the large carriers, the AIGs, the Zurichs, will take our phone call versus someone smaller. And sometimes certain risks are just harder to get coverage for, like, say, multifamily apartments. A lot of carriers won't touch it. So you need to go talking to people in London. That's where we have our experts who can help with that. So it's, I guess this question sort of, you think about your growth plans, you're trying to get to the next level, you take on larger projects, more exposure. Your owner developer wants you to do a wrap. That's where we can come into play.
Well, thank you so much, Brian. I'll wait just a couple of seconds to see if there's any other live questions that come in. But if anyone wants to reach out to you directly, how's the best way to do that? Is it email? Is it following your
Sure.
LinkedIn?
all the above. You can, obviously, I'm on LinkedIn. I'm always happy to take connections, happy to do that. My email is pretty simple. It's Brian, BRIAN, .hunt@usi.com. You can also call my cell phone, 214-202-6982.
You got it. Well, Brian, thank you so much for hopping on and telling us all about the landscape of risk and insurance. Hope everyone gained a lot of insightful information. I was certainly reminded about all there is to need to know about and just what's covered and what's not. So thank you everyone for hopping on. Thank you, Brian, for leading this. And thank you to my behind the scenes team at Lane Gorman Trubit. Thanks for coming.
Thanks, everybody.